Hey everyone, welcome back to the Crypto Code. To understand what a smart crypto portfolio looks like in 2026, we first need to talk about what actually happened last year because the market sent a very clear signal. U.S. stocks moved higher, international markets did even better. Commodities completely outperformed both. Gold surged, silver exploded, and yet crypto struggled to keep pace. While most major asset classes delivered strong returns, the broader crypto market finished the year down. And that's why so many investors are now asking a tough question heading into 2026. Does crypto still belong in a serious portfolio, or is capital better deployed elsewhere? And if crypto does still matter, which parts of the market actually make sense to hold? This is not hype nor price predictions, but rather how to think about a practical and realistic crypto portfolio for 2026. Let's talk about it. Before we jump into today's topic, we want to remind you that here at the Crypto Code, our goal is to provide you with the top news, research, and tips when it comes to finding projects with huge profit potential. Stay to the end of this video and learn how you can earn $10 in Bitcoin and a free weekly trade alert just for attending one of our free workshops to learn more about who we are and what we do. No purchase needed. Our trade alerts have a 93% win rate, so make sure you take advantage of this free alert. Remember, I am not a financial advisor. This is not financial advice, so do your own research before you make any crypto trades. Okay, so the most important lesson from last year wasn't just what went up, it was where money flowed. International stocks significantly outperformed U.S. equities, and precious metals outperformed both. That tells us capital didn't disappear, it rotated. A weaker U.S. dollar helped boost foreign markets and commodities. At the same time, geopolitical uncertainty, trade concerns, and long-term policy questions pushed institutions to reduce U.S.-centric exposure. Emerging markets benefited, hard assets benefited. Crypto did not, at least not yet. To understand why, you have to zoom out and look at how capital allocates across risk. Every asset sits somewhere on a risk spectrum. On one end are lower-risk instruments like government bonds. On the other end are higher-risk assets like small-cap equities and crypto. As confidence improves, capital naturally moves further out along that spectrum. But here's the key point most people miss. Not all risky assets attract capital equally. In 2025, investors willing to take on more risk didn't choose crypto, they chose international equities, industrial commodities, and select growth sectors. At the same time, at the lower risk end of the spectrum, central banks continued accumulating gold instead of bonds, which helped metals massively outperform. Crypto was effectively skipped on both sides of the risk spectrum, so the real question becomes whether that changes in 2026. Historically, crypto doesn't lead early in macro cycles, it usually moves later, after liquidity stabilizes, after uncertainty fades, and after institutions feel comfortable taking exposure to high volatility, non-sovereign assets. If global risk appetite continues to expand and monetary conditions loosen, crypto becomes a logical next step, but that doesn't mean everything pumps at once, and it definitely doesn't mean every coin benefits equally. That's why an optimized crypto portfolio for 2026 isn't about being all in or all out. It's about selective exposure. In practical terms, that means a strong core allocation to large liquid assets with institutional relevance. It means exposure to infrastructure and networks that actually see usage. It means smaller, controlled allocations to higher upside sectors. And it means avoiding heavy exposure to tokens that rely purely on narrative. Crypto's role isn't to replace traditional assets. Its role is to provide asymmetric upside when conditions align. And that brings us to the most important takeaway. Crypto didn't underperform because it failed. It underperformed because capital wasn't ready for it yet. Markets move in cycles, capital rotates, risk appetite shifts. 2026 isn't about blind conviction or abandoning crypto altogether. It's about positioning intelligently before sentiment changes, not after. Let us know in the comments how you're approaching your portfolio this year. Thanks for watching the Crypto Code. If you found this video helpful, please like, subscribe, and hit the notification bell for more crypto insights. Let me know your thoughts on today's video in the comments below. You can also check out what we do here at the Crypto Code by registering for one of our free workshops where we show you how we and our students profit in crypto, no matter if the markets are up or down. If you register for the workshop, you also get access to a free weekly trade alert. Attend our free workshop, take a short quiz at the end, and we will send you $10 in Bitcoin. No purchase needed. We've already given away thousands of dollars worth of Bitcoin just this year alone. Just look for the link in the description of this video to register for the workshop. It will be worth your time. Our public trade record currently has a 93% win rate, and you can view it here. Best of luck with your investments, and remember to stay informed and stay safe in the crypto world. See you next time.